For TraderInsight.com, I'm Adrian Manz, and let's talk about volatility. Now, some of you are watching this live. Some of you are going to be rejoining us this afternoon for sort of the identical session where we're going to talk about all this stuff again. And still others are watching the recording. But one way or another, the reason you're here today is to talk about volatility, because we've had lots and lots of volatility recently. So ever since the lockdown started, we've seen things happen like a VIX of 85. VIX of 85 implies that we're going to get a huge move in the S&P futures over the course of 12 months, a big move over the course of 1 month. We saw all of that happen. Then we saw the VIX settle in. We saw trading get back down into a semi-normalized range, still very, very volatile. But there's been opportunity. The opportunity has not been in sort of the core trades. The opportunity has been in going out there, looking for volatility, getting in front of volatility, and making sure that we have strategies that capitalize on it. So our primary emphasis has been on the first hour trades, and that's really what we're going to talk about here today, is just stuff that goes on in the first hour of the trading day. And why don't we just dig right in, get started, and then hold your questions till the end. We'll go through them. I've got all the time you guys need, but let's have a look at what it is that the volatility is doing to the markets. All right, here's a disclaimer for you to read. Obviously, nothing here is investment advice. Everything here is predicated on the fact that you understand it before you go out and try it. Past results are not indicative of future returns, and just because one guy can do it doesn't mean that everybody can do it. So those are the obvious caveats. Read through all this stuff, bear it in mind, you know what it says, and once you did, we will get going. All right, let's talk about our strategies. And when I say our strategies, most of you know that's Julie and me. We started looking at this stuff back in graduate school, and what I can tell you for sure is we fell in love with the idea of trading for a living and researching this stuff. As you know, researchers, graduate students, it's all about publishing. It's all about disseminating what you've learned and what you've done over the years. We certainly have done that. You can read about all the strategies that I trade or that we've used in our trading over the last 20 years in just tons of periodicals that have been published. We have got books out there, right? Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. That's the one that started it all. And it really sort of went through and took everything that we do and condensed it into a strategy, a system, a way of looking at the world, a way of looking at trading. And we framed it against the metaphor of baseball. So I'm not going to say I'm the world's biggest baseball fan, but far and away, I thought baseball was a very good thing to parallel trading, because the discipline and the psychology that are required to go out there and swing at that ball are very, very similar to the morning experience of any equities trader. So you guys know what I'm talking about if you've been doing this for a while. The rest of those books are variants on what is in Around the Horn. So Trade Secrets is all about a strategy that I'm going to show you today. The fastball strategy, the expansion of range and volume. And then, of course, World Cup Trading is the Italian version of Around the Horn. And Beat the Street and Trade Secrets, those two on the right side, those are the worldwide releases. So it's all good stuff. You know, what I'll tell you is you're probably going to get a lot out of just sitting here today and going through these things. You can drill down on the website if you'd like. You can go in and have a closer look at some of the strategies and what it is that we do and how we do it. There's explanations in the members area of each one of the patterns that I look for as an intraday trader. So let's talk about how we get ready to profit from the open. This is about three things. It's about strategy, it's about discipline, and it's about psychology. I've got these up here because I find that the disconnect that a lot of people have is between their personal psychology and what it takes to trade. So they'll go out and they'll wrangle up some trading system that they see, or they find out that, you know, somebody's making money doing something, and they decide, geez, you know, this is what I want to do. I want to do exactly what this guy's doing. It looks good. It makes a lot of money. And they put themselves in front of it, and then they can't do it. And they don't understand the dynamic of why they can't do it. And it's really because the discipline and the psychology of the person who put that program together have to be pretty similar to yours, or else it's going to be very difficult for you to go out there and replicate the results. Doesn't matter how good the strategy is, doesn't matter how easy it is for the author of a strategy to replicate it. It's got to be a good fit for your psychology and the way that you're wound and the way that you like to do things. Most of my trading is all about automated opening continuation trades, super cap volatility band opening trades, and 2SD gap mean reverting trades. Now I'll tell you right now, those opening gaps, that's the thing that sort of put me on the map. A lot of people know who I am because of the Baltimore Chop 2 standard deviation opening gap mean reversion trade that I do. People love it. It's mathematical. It fits for the engineers. Everybody seems to love doing that trade. But it hasn't been working in this environment because you think about it, it's 2 standard deviations of volatility. And what does it take today to go out 2 standard deviations of volatility compared to in a normal market situation, right? So things would have to gap so far that it just doesn't even make sense to look at them anymore. And that's the reason that we've been focused on these other 2 things as our primary source of trading opportunity over the course of the day. And as this is a webinar or a seminar that's focused on what's working right now, we're going to focus on those 2 things. Now, when I say discipline, my discipline is pretty specific. I am very much a plan the trade, trade the plan kind of a person. I think it's the only way that you can really succeed. And we've got very precise entries on everything that we do. So everything's based on prior price action. And then we've got entries and targets and stops and intraday money management that's all based on very logical stuff like support and resistance. So in the case of stops, if it's going to be a stop out, it has to violate a support or a resistance level. Our profit objectives are based on prior support and resistance. So a lot of times what I'll do is I'll base my profit objectives on levels from a daily chart so that if we have a stock that's going into some kind of a continuation move, that continuation is targeting something in the bigger picture in terms of the profit objective, and the stop is based on the smaller picture, right? The intraday trading, the 5-minute charts, the time frame that we actually trade from. That's where we're getting the stop losses from. And I've got very objective money management rules. So what goes on in my trading is I'm looking at in the core trades, let's say in the around the horn trades, I've got an entry, I've got a target, and I've got a stop loss. When I get into a position, if I get 50% of the distance to the profit objective, I'm moving my stop to break even. If I get 10 cents to the profit objective, I'm moving my stop to the 50% level. So it's trailing, right? It's pulling up in behind it. But it's not this arbitrary thing that you see a lot of people chasing where they just want to lock in some profitability. So what they do is they say, well, I'm going to move my stop up to $50.10 because that'll lock in a big chunk of the profit. And then what happens to them? They just get stopped right out of the trade because they put their stop where they'd like to keep the money. And the market really doesn't care how much you're willing to lose. It doesn't care how much you're willing to or you want to make. It's all about, are things logically based in line with the order flow? So we're order flow traders. We're all about figuring out where the order flow is, where's the volume by price stacked up, what's the tape look like, how does that all relate to the charts? That's how we find our targets, that's how we find our stops, and that's how we trade the scalp trades that I'm going to talk about in a minute here. Now, when it comes to planning the trade and trading the plan, we are very, very specific as to where we're going to enter a trade. We've got a specific level we're going to get in at. We don't allow things to slip. We've got order structure that goes and controls how much slippage we're going to have on any given trade. And if there's more than that, we're going to wait for the stock to come back to us. We also automate the money management. So like I said, it's very much everything from a plan trade to an intraday scalp trade. Everything is set up in a way that we know exactly what we're going to do before we're going to do it. So money management is something that takes care of itself. We're never beating ourselves up afterwards because we tried to go and extend a profit objective or we tried to go and jockey a stop around, because that always leads to disaster. I've never seen in 25 years of doing this somebody who can successfully go and take what they plan to do and then change the plan all up during the day and say, oh, it's at the profit target, so I'm going to go ahead and I'm going to go and get myself an extension of $1 or $2. They're always getting stopped out further down in the range. They always get punished for violating their discipline. So we exit at the stop or we exit at the target, but one way or another, we go into the session each and every day and we are ready to profit from the open. So we're looking at the opening bell and we're saying this is our opportunity. A lot of people shy away from the open. A lot of people historically have said, they wait for the market for, 10, 15, 20 minutes, or they don't even trade the first half hour because they don't want to be in front of the volatility. I like to be in front of the volatility. So if this style of trading that I'm showing you today is something that appeals to you, then understand that little bit of your own psychology is you want to be in front of the volatility. You want to be there at the time of the day that the market is most likely to have the biggest reactions to whatever's going on in the broader indices, what's going on in the world. Geopolitical stuff affects it more in the first hour or so of trading. All that stuff stacks up, and what it does for me is spells opportunity. When we talk about psychology, one of the things that we're really talking about is your relationship with money, your ability to follow through, and your comfort with risk. So once you get those three things in place, the other factor that nobody considers is what's your frustration tolerance? Are you bored easily, right? Do you characterize yourself as, geez, I think I've got ADD because, I can't sit down and look at something for more than 5 minutes without having to go back and reread the same thing because my mind's wandering or I get bored. This is boring stuff. People try to make trading this very exciting thing. And sure, it's exciting if you have a good day or if you have a good trade. Everybody gets that adrenaline rush, I guess, but it's not about excitement. It's about consistency, and it's about sitting in front of a machine and being willing to be bored for a little bit while you wait for things to happen. Sometimes I'll wait for a trade to come to us all day long, and it never does. And that's okay. I don't care. Because I know that if I don't have my psychology tuned to deal with boredom, I know what's going to happen. I'm going to fire off trades. I'm going to have lots and lots of excess trading activity in my account. I know people who've had 400 or 500 trades in one day when their plan was really to take 2 or 3. They just kept thinking, this one's got to work, this one's got to work. And it was all about, I just missed something, and they get frustrated. Just wait for the trades to come to you, and you will seldom go wrong. So here's a little brain twister. If you're watching this, and you're of an age that, I can say that we're sort of getting to be, you're middle-aged, or you're older than middle-aged, or you're retiring, and you're wondering if you can change things up. Let's just do this quick little exercise. I do these at the live events. I wish this was a live event. I wish we were in a room together, and that's really where I like to be. I like to be in front of a crowd. I like to see the looks on people's faces and figure out if they get what I'm saying or if it's making no sense at all. But I still think that this has always been just a little quick quiz that makes sense to people, and it kind of tells you where you're at. It's not a hard and fast rule that's going to tell you whether or not you can be a good trader, but it's going to tell you a little bit about yourself. So let me begin this by saying Julie and I are both psychologists, so we like to follow a lot of the research on sort of how people learn, how adults learn. That's been a big thing that we've done over the years at these boot camps, and lots and lots of training, online training, boot camps. All this stuff fits together in a very specific way, and that way is we understand how adults learn. So this is where we're coming from when we look at all this stuff. And this little quiz is going to show you a little bit about how flexible your thinking is. So the more stuff you do in life, this is the good news, that encourages flexible thinking, the more flexible your thinking will become, and the more readily learnable some of these stock market principles are going to be. So you don't want to keep trying to pound the same square peg into the round hole. You want to start being able to look at things a little differently. So let's go through the quiz, and I'm going to read you the questions as we do, and then just set up a 1 through 8 kind of a column, and you're going to do a true or a false, and then we're going to go through and give you a quick way to total them up and just sort of tell how flexible your thinking is. So we're going to do true or false, not disagree a lot, disagree a little. Let's just do it the easy way, since you guys aren't in a room with us and we can't go through these, tally these results with you. But no matter how much intelligence you have, you can always change it a good deal. Is that true or false in your mind? No matter how much intelligence you have, you can always change it a good deal. Number 2, You can learn new things, but you cannot really change your basic level of intelligence. Would you say that's true or that's false? When you think about yourself, you can learn new things, but you cannot really change your basic level of intelligence. Number 3, I like my work best when it makes me think hard. True or false? So think about yourself. Think about how you work. I like my work best when it makes me think hard. True or false? Number 4, I like my work best when I can do it really well without too much trouble. True or false? I like my work best when I can do it really well without too much trouble. True or false? Number 5, I like work that I'll learn from even if I make a lot of mistakes. I like work that I will learn from even if I make a lot of mistakes. True or false? Number 6, I like my work best when I can do it perfectly without any mistakes. True or false? I like my work best when I can do it perfectly without any mistakes. True or false? Number 7, when something is hard, it just makes me want to work more on it, not less. Again, number 7, when something is hard, it just makes me want to work more on it, not less. True or false? And here we go, number 8. To tell the truth, when I work hard, it makes me feel as though I'm not very smart. True or false? To tell the truth, when I work hard, it makes me feel as though I'm not very smart. Now, here's what I want you to do. You've got number 1 through 8, and you've got a true or false for each. Take number 1, number 3, number 5, and number 7. And if you had a true for those, give yourself 1 point for each true. Then take number 2, number 4, number 6, and number 8, and score them the same way. True is 1 point, false is 0. And now, just look at those two numbers. So 1, 3, 5, 7, add up all the trues. 2, 4, 6, 8, add up all the trues. And I'm sure it's not much of a spoiler alert because it was a little self-evident what those questions were measuring, but the odds have it. If you answered more trues to 1, 3, 5, and 7 than you did to 2, 4, 6, and 8, then you understand that you can increase your intelligence by learning. You're not afraid of a challenge. You believe working hard is the best way to learn, and you're willing to make mistakes along the way. So those are the characteristics that this little test measures. I hope you found it fun. I hope that if you look at those answers, you can see that they're not absolutes. They're things that you can definitely change about yourself. And once you go through them and you find out that, maybe you're not the most flexible thinker, right? Maybe you weren't so high on the odds, you're a little higher on the evens. That just tells you that you've got to go and just tell yourself, you know what, I can do this stuff. I can do something different than what I'm used to doing. I just have to believe that I can do it. So a lot of trading, I find, Julie finds, all the people we work with find, is about believing in yourself and believing you can do it. It's no different than my kid. He's 12 years old. He can do amazing things. He's always frustrated when he starts. And he'll just look at me, or he'll look at the people we go skiing with, or he'll look at the people we go do anything with, and he'll say, I just need to believe in myself. So keep that in mind. Keep that in the back of every thought that you have, and I'm going to tell you right away, it's going to make life a whole heck of a lot easier for you, especially when you're trying to tackle trading. This is a very difficult business. It's a very non-intuitive thing to learn, and getting yourself in the right place while you're learning it, that's one of the keys to success. Now, let's get into the thick of it and talk about the strategies. So strategy number 1, this one has really been knocking it out of the park, especially while the volatility has been high. This is something that I call the fastball expansion of range and volume. If you've been following my stuff for years, then you already know what the basic pattern for this setup is. This one has some enhancements. This one has a little bit of alternative data that I go looking for when I set up the trades. You don't have to do that. You're not going to need the alternative data feeds in order to make this thing work. I'm just telling you that they really help in narrowing down the range of opportunities. That's how these results that we'll show you in a few minutes here were tabulated, was based on the nightly work that I do. How many dollars per share, how many points per share traded does the strategy book over time. So this has been very consistent month over month, year over year. It books about 10 points, $10 per share traded per month. I don't know why that wound up being the magic number. It just is. Sometimes there's fewer opportunities, sometimes there's more opportunities, but they're all based on the pattern that I'm about to show you. So let's get right into this. Let's look at the strategy guidelines. First off, you are looking for a breakout from a pullback or a consolidation. You're going to want to see the widest range of the past 10 days, big bar on a chart. So when you're looking at the chart, this pattern should just jump right out at you. If you can't flip through the charts and see these things, I mean, you can go out and buy, Metastock has a great piece of scanning software for this. There's a bunch of licensees over the years who have gone and put together scanners that can find these things. But this particular pattern, if you can't just flip through the charts every night and find out of 1,000 charts that you can flip through in maybe an hour, if they don't jump out at you in just 1 second of looking at the chart, then you're looking too hard. This has to be a pattern that just is very evident. It's very much part of how I think. It starts market cycles, it starts the ball rolling, and you're going to see that once you can spot these by flipping through charts, it's going to make your trading just a whole lot more meaningful and just easier to understand. Number 3 here, we want to see greater than average volume. It's important to see the widest range of the past 10 days. Volume needs to be at least significant. You don't want to see volume that's just sort of way down in the profile. You want to see volume that on that given day that you had that big breakout bar or breakdown bar, you had some significant volume to go along with it. And then what we're going to do here is tomorrow we're going to enter just beyond the extreme of today's bar. So if you guys are around the horn fans, you know that way back when we used to enter 1/8 of a point higher or lower than a bar that was moving up or down respectively. In the case of the NASDAQ trade, which is the fastball XRV, what we're doing is we are just going a penny or 2 pennies. And here's what the pattern looks like. This is just so simple, so easy to spot, right? You've got a trending move. So let's say that orange arrow there represents a big trending move to the upside. That trending move gets you up into the range. You get this pullback. And then after the pullback, what you get is this wide range bar. That's the biggest range of the past 2 weeks, right? 10 trading sessions. And it gets hopefully sort of up and away from overhead support or resistance. And then the following session, we're going to look to get long, 10 cents above that high. In an intraday chart, now mind you, these are daily bars, I should say again, the patterns pop on the daily bars, and then we trade them intraday. So I just want to make sure that everybody's clear on that, because usually I forget to say it, and then somebody says to me, what time frame were you looking at on those charts? So these are daily bars. Here's another version of the pullback. This is the short. Here we have a downtrending market. Here we have a pop to the upside, and then we have the expansion of range and volume bar to the downside, and we're going to go short in this case, just a few ticks below on the XRV of the low of that daily bar in the following day's intraday trading. You should have noticed that the pullback is always looking for a directional trade. So we want to take the trade in the direction of the original trend when we're looking at a pullback. The breakout is always valid if and only if it happens directionally with the prior trend. And there's a difference between this version and the version 2, which is the consolidation. We'll take this either direction because you don't know until a stock is trading in a consolidation range whether or not that is accumulation or distribution. I don't care who tells you they know, they don't know. You don't know until it breaks out what this was. So when this gets into this range here, that could be accumulation that leads to a markup, or that could be distribution, which is going to lead to a markdown. In this case, you see the pop out of the range is an expansion of range. It's up and out of the range. If it goes a tick above that in tomorrow's intraday trading, we're going to look to go long. And in the case of the XRV, we've got some very specific profit objectives that we're talking about when we're trading it. So it's not looking at support and resistance the same way that the around the horn trades are, the NYSE trades. These are NASDAQ, and they behave a little bit differently. Different animals than NYSE and the NAS, right? Even to this day. Here's a reversal consolidation. This one, you've got a trend to the upside. Then you've got what turns out to be a distribution range followed by a markdown. That markdown is happening on the heels of this fastball expansion of range and volume bar. We're going to look to go short in this case, a tick or two below the low of that bar in tomorrow's intraday trading. These can also be trend following. So here we have a trend to the downside. We've got a consolidation. This again is a distribution range. We've got an expansion of range, expansion of volume to the downside. We're going to short it, right? Then this is all a no-brainer, but I think it's when I don't put it out there, people ask questions that imply they don't really get what I was talking about. So let's just look at them. Downtrend, consolidation, that's an accumulation range. Then we get a pop to the upside, and in this case we're going to go long above the high of that bar. So trend, counter trend, the consolidation range, as long as we get that expansion of range and volume to break us out of it, is going to be the trigger for our entry. So now let's talk about the discipline. We are going to focus on identifying and confirming opportunities. I use conditional orders to establish bracketed entries, and I enter only when a trade is within allowable slippage. I'm going to enter only when price is moving in the planned direction. So what's that mean to you when you're putting together your trades, right? If you go out there and you try to establish a bunch of trade automation, one of the things you have to be careful about is that if you're going to enter a long position, it's not as stock price is falling down through you. So what's that mean to you in terms of how you're going to structure trades? So I think it's very important to understand the different types of trades that you can set up. And when I say a conditional order, the reason I'm using conditional orders is a conditional order doesn't impound margin. So the conditional order rests right here on my machine. It doesn't go out to the market until the condition has triggered. And the condition is price has to be, let's say it's a long trade, price has to be below my entry price, traveling toward my entry price in order for the order to go live. So then let's say it's trading 15, 20 cents below my entry, and that's where I have the trigger set. 15 cents below my entry price, it goes and it says to my broker, all right, if the price trades to the entry price, then get me long, stop limit, right? The stop is the trigger price, the limit price, the worst slippage that I'm going to accept. And what that does for me is it eliminates the probability of, let's say I want to go long, but we've got a 400-point gap in the market this morning. Market gap's way higher. And once it's up there, it starts coming in. I don't want to get triggered into a long trade as price falls through my trigger price. I only want to get triggered long if price comes up to my trigger price, traveling in the proper direction. I want to see a repeat performance of yesterday's momentum to get me into the position. I don't ever want to be in the position of catching a falling knife. Here's what an opportunity for one of these fastball XRV setups looks like. So on a daily chart, this would be a wide range bar. I'll show you that on the trading plan in a second here. But what you're seeing intraday when you go back and you break the bar down is you've got a very persistent trend over the course of the session. So this stock, this was on yesterday's plan. We all know what happened, or for those of you who don't know what happened, we'll see in a moment here. The setup for the trade was perfect. You can see that the price persistence over the course of the day was there. The algorithm goes through and looks for a lot of the signals that are telling us that it's the same market participant who's doing the buying. And as we go and validate that the trade is actually one of the trades that has the hallmarks of being a successful setup, we go through and we put it together for the following trading session. Another thing that we look for is what happened over the course of the day as price moved through various ranges. So I like to have a volume weighted average price for the session, and I like to have an anchored VWAP. The anchored VWAP I'll move frequently to see what happened during one trend, what happened during another trend. In this case, what you're looking at is just two VWAPs. This is a very easy one to conceptualize. That big move from the opening bar to the closing bar is represented by the long dotted blue line. So that is the VWAP for the whole day. Then this little move here has a volume weighted average price that's up higher. So what that tells me about what's going on here is that The higher VWAP, which is the trend VWAP, is giving me an indication that we are going out really strong, that a lot of what's going on into the end of the session is in fact happening where all this volume by price is clustered, and that this level right here the following day, if it's violated, is going to make for a good place to put a stop. And then the broader session VWAP, I just like to look at these things and see what's the reaction over the course of the day when price starts to extend from the VWAP. Are they chasing it? Are they trying to get those orders filled? If they are chasing it, how far is it going? What happens when it comes back to the volume weighted average price? Does it get pushed higher very quickly? Right? That's indicative of how institutions trade and what the institutional traders are looking for. The trading plan that I put together for this each and every day is pretty simple to follow. You can see here that, I've got a chart that shows the trade as it's put together, let's say the expansion of range, the expansion of volume set up for the day. And then I've also got a floor trader pivot grid that tells me whether I'm going to be long or short the next session. So what's this do for me? When I see that I'm going to be long and that there is a resistance line that's closer than $1 to where I'm going to be entering the trade, then what I do is I target that first resistance. So that's on a long. On a short, we would be targeting the first support. So why is that? Well, we did a lot of research, we did a lot of work going through and very methodically figuring out what the ideal targets for these are. It sounds arbitrary, but it's either $1 per share traded or first resistance or first support, whichever one comes first. And that has been able to keep us in these trades long enough to get to the profitability factor, and just over the course of the few years that we've been keeping tabs on this thing, it's been the way to trade it, so it's the way we do it. We're not arguing with the statistics, we're just going in there and doing what the market tells us to do each and every day. So once I see that trading plan every night, I know exactly what I'm going to do the next session. Here's the way I would set the order up. You can see here, that's Atlas Air Worldwide Holdings Incorporated. And you can see that the trade is set up exactly by the parameters that I just gave you a moment ago. So we know that we've got a price time trigger. So we have to have a last price that's coming in from the right direction. So it's coming in from below. It's got to be less than or equal to $27.16. And as long as it's less than $27.16, what this conditional order is going to do is, as long as we're trading after the opening bell, that's why I have this activation time here. Right? Opening bell is 9:30 in the morning Eastern time. We're going to go long 27.16 stop, and we are going to use a 27.22 limit. So that means we're allowing for about 6 cents of slippage here. Once we place that order, we get a second order that we're going to have to put up. This order is called an order trigger. And on an order trigger, what we're doing is we're saying if that last order triggered, then what we want to do is get out for a profit if we hit $28.01. Similarly, what we're going to say is if that order triggered, then what we want to do is we want to get out for a stop if we get to $26.53. Now notice in both of these cases I've adjusted the volume. So the dependent volume for these two orders, what dependent volume means is it's dependent on that first order triggering. So if that order triggered, these second orders are going to adjust the volume to accommodate how many shares we actually got filled for. It's not just randomly going to fill us for the entire amount that we have down there in the quantity box. It's going to go through and say, well, gee, you only got filled for 367 shares. So it'll adjust that fill size to accommodate where we actually got into the market. And then when our stop market order hits, it comes down and it stops us out. If that's the end result of the trade, then it's going to get us out for the same number of shares it got us in for. So here's what this one looked like when it actually triggered. It was very fast right on the opening bell. These frequently are. It doesn't really help to sit out too much on these around the open. The volatility in this case usually winds up taking it almost directly to the target if it triggers and it's going to go to the target. Unfortunately, it can also wind up taking you down to the stop, but sometimes that is the way that it goes. So the volume by price support here, you can see, is at this line. Volume by price is out on the right side of the axis here. It's on the y-axis. What happens here is we are looking at right around the opening bell, right on top of yesterday's closing range. We know we've got a support area. Then we've got that volume weighted average price support stop from the prior day. And then you also know, of course, that we have that full day's VWAP down below. It's right here. So all these things fit together as pieces of a puzzle. What they all rely on is a trader's individual psychology to make them work. So you have to be comfortable putting the trade on. You have to be comfortable putting the order out there and letting it go and being confident that it's actually going to go in the direction that you intended it to go, or that the worst case scenario is it's going to stop you out. A lot of people take very personally when they get stopped out of a trade. It's not really so much about the money. It can be, of course, but it's oftentimes more about ego. There's a lot of ego wrapped up in trading. A lot of people get pretty focused on their self-worth, when it comes to figuring out which direction the market's going to go. And that's really something you should work on if it's part of how you're wired. You want to be able to go in here objectively and just say things are going to happen because they happen. My son famously says, "Daddy, they're going to go where they go." This is a picture of one of our boot camps. And around that table, what you see are 20 people who all have different psychologies. They come from different fields. They're engineers, they're lawyers, they're physicians, they're dentists, they're people who are involved in the real estate market. You just go through and they come from every profession that you could ever think of and every background that you can ever think of. And the thing that they have in common is they all do a really good job of wrapping their head around the fact that their psychology is going to be the thing that is hardest to conquer in this entire endeavor here. It's not about figuring out the best trading strategy. That's important, right? You need a trading strategy that's good. Obviously, you don't want to go in there and trade something that never works. But at the same time, all of them share in common that they've worked really hard to get to the point that they're going to sit down and they're going to conquer something and they're going to make it part of how they think. It's no longer something that's on the outside. It's something that is within, and it's something that they can make work each and every day that they're trading. So that's how these people become successful. That's the thing that I think is going to be key to everybody's success. Anybody who's listening here, this is factor number one that has to come into play, is your psychology and your acceptance of, I can go learn this stuff, but I also have to adopt it as part of the way that I approach trading in general. With that said, let's go on and just talk about a couple things that relate to psychology. And, one of the biggest is don't micromanage. I've got lots of traders who I've worked with over the years. We really sort of cherry pick, and we work with about 40 people a year. We're very careful about who we work with. We have 600 applicants for our boot camp, for that event that you just saw there. 40 get accepted. And we work very closely with those 40. And I can tell you that even though these are people who are well tuned for what it is that we do, one of the first things we have to do is tell them, you can't watch every tick. Because they do this, and this is a universal. People sit there, and especially if you're just trading one or two things over the course of the day, you start sweating every tick. You second guess your planning, and before you know it, you're exiting trades early, or you're not getting into trades because you're waiting for double, triple confirmation. It's never the case that second guessing your strategy is a good thing, because when you do, what happens is you're going to become less and less confident that you know what you're doing, first off. And second off, it becomes this bad habit that's just awful to shake. It's very, very difficult to go back and unwind this line of thinking when it happens to people. So you have to be very careful just to not have it be part of who you are as a trader from the get-go. And one of the things that you can do to make this not a factor in your trading is to get that profitability off the screen. So I think that a P&L on the screen is just one of the worst things that you can do. It forces you to focus on the wrong thing. You get nervous because you see price moving against you, or dollars moving against you, or you get excited because price is moving in your favor. That will lead to taking profits early and letting losers run. It'll lead to cutting losses off too early, just artificially. I'm in, no, I'm out. I'm in, no, I'm out. I've got to get back out of this thing again. And, really the best thing to do is watch the chart, see it play out. Is it playing out the way that you thought it was going to? Well, it doesn't matter then what the P&L says, right? Follow things through to their natural conclusion. focusing on the numbers, as I said a second ago, it tends to make people, because taking losses feels bad and taking gains feels just very good and reinforcing. What a lot of people wind up doing is they take progressively smaller gains and they take larger losses, because what's happening is it feels good to take the gain. So every time they have a quarter point, boom, they take it. They get another quarter point, they take it. They've got another quarter point, they take it. Well, then it starts traveling below the range that they're looking for it to trade in. And what happens? It gets down to a support level. It breaks through. They should stop out and, wait a minute, you know what? Maybe that next support level is the one that I want to go out at. And then it gets to that next one and, well, you know, I'm in it now. So I'm going to hang with this because now it's sort of a different trade than I started with. So I'm going to let it go down to here. And, you know, this is where the new parameters are on this thing. And before you know it, you've second guessed yourself right into a hole that you'll spend a whole day or a whole week trying to crawl out of. So just don't do it. It's a bad habit, and it's best to just focus on the strategy. Don't micromanage. And the measure of your success on any given day, I tell my traders this all the time, measure your success by whether or not you did what you said you were going to do. Plan the trade, trade the plan. Did I do what I said I was going to do today? If the answer to that is yes, then you're so far ahead of what most people do that you really have managed to give yourself a competitive edge. Now let's talk about participating in the open. And, you know, why is this different than what we've been talking about so far? It's really not. It's just a different way of thinking about trading this particular trade. So if you've been to boot camp, if you're one of our long-term traders, you know, people who've been with us for 7 or 8 years, you know that a big part of what we teach people to do is workflow. How do you go from the pre-market or even the overnight, right? So what are you setting up tonight for tomorrow, those conditional orders? What are you doing in the pre-market? You're planning your Apple trade, you're planning your opening trade in Apple or Baba or Tesla or whatever it is. And then after the first 5 minutes, you're moving on to the opening gap trade, so those 2SD reversions. Then you're going back and you're managing the XRVs, making sure that everything there is going off the way that it should. What if instead of that, what you want to do is focus your attention on just the opening trade, the Apple trade, and you want to extend it over the course of the whole first hour? You know, this could be Apple, it could be Baba, whatever, you know, whatever it is that you're trading. It's got to be a high flyer. It's got to be something that has a lot of volume. And obviously it needs to be something that you can actually work with around the opening bell. But if that's what you wanted to do, then this is the trade that we're talking about here. So a bunch of you are currently in the program, the mastery class program, where this is what we're learning. It takes a long time to teach it, right? I'm sorry that you can't just impart the knowledge overnight, but this really is something where you just sort of need to see something over and again. You need to see different ways of approaching an open, if there's a gap, if there's an inline open, if the volume's off, so there's a bunch of things that we consider when we put this trade together. But what I want to show you here is sort of the nuts and bolts of the basic trade and what it is that I'm looking for when I put that volatility band set up together each and every night that you guys get on that NASDAQ scalper plan. So here is the first part of this. You have to know your stocks. So before you ever go and you try to put together a trade like this, you need to create a short list of stocks that you're going to be willing to trade. So these, I don't focus on NYSE, right? We had focused our trading on NYSE for a big portion of our career, the New York Stock Exchange. But this incorporates a bunch of NASDAQ stuff as well. So I want to see something, in my case, trading better than $100 per share, has an average daily travel range of more than $2 per share. Volume is better than 6 million shares per day, so that you got a really liquid stock like that. It makes it easy to get in and out without getting giant slips. I want to see the opening bid-ask spread. Opening, I mean when I'm willing to take my first trade. So the first time over the course of a session that I'm willing to put a trade on, I want to see that bid-ask spread has narrowed down. So in the case of some of the lower dollar candidates, I want to see it down, 10 cents or so. Something like Tesla, of course, is probably going to be, 15 or 20 cents. But I don't want to see those dollar spreads or $2 spreads that you see around the open. That's bad news. And then the other thing that we're going to focus on is we want to see the volatility have profit potential. So we want to isolate visual trading ranges. I want to see peak to trough support and resistance that has lots of inflections. I plan those trades for tomorrow using today's open to close bias. So if today was a big up day and I've got a bunch of volatility bands that I can draw, then my bias going into the open tomorrow, if there's not a gap, is going to be positive. I want to see the stock moving up into those volatility bands, not down through them. I watch the pre-market trading activity. I want to see the proximity to the bands in the pre-market. Is it inflecting today where it inflected yesterday before we even have the cash session open? And then, as I said, I'm going to trade with a directional bias into the first violated band, and then I'm going to target the next band. So the trade is going to get put on as price comes to me at a band, and then I'm going to target the next volatility band on the hierarchy once I am in the position. And then I'm just going to trail at the prior band as I extend. So you're going to see how all this is put together in a second here. But essentially, the volatility bands are suitable for stocks that trade with certain behaviors. And what we really want to see when we look at these symbols, right? So I had there, you saw Apple, Baba, Netflix, Tesla, Nvidia. We just want to see things that have the potential to get stuck in trading ranges. We want stocks that are participants in program trades. This is the gist of the whole thing. We want to see a level of program trading activity that makes it very predictable as to what the stock is going to do over the course of the session. What's it going to do when it hits support? What's it going to do when it hits resistance? We've gone through the exercise by that point of drawing these lines that I'm going to show you in a second here. And we want to see that over the course of many, many days, those predictions that we're making about market behavior in fact come true. So that's why we're choosing this list of stocks. And the one that I'm going to focus on here today is Apple. So participating in the open with Apple is something of a specialty for me. You guys who follow us in the First Hour Trading Pit, or if you haven't been to the First Hour Trading Pit, I will pop up a slide for you that will give you a number that you can text to. You should have already seen that in the registration link for the seminar, but I'll make sure to get that into the presentation here before we close, and you can join us and watch what we're doing. But Apple, we go through, and the night before, I'm setting up these volatility bands. So you can see here that I've got each level of potential volatility isolated. So these are the trading ranges that Apple was in during the current session. And this was yesterday's information. And what I did yesterday was isolated each one of these brackets. And then out here, I confirm those isolations by using this volume by price. So you can see these red boxes are constraining the volume by price, and those red lines were going up and showing you where I thought the inflections were going to be. And I transfer all that to my trading plan. So surprise, surprise, right? I've got a plan in place to trade this stuff. You guys know I'm a big advocate. Plan the trade the plan. What I do is I take all those zones from the chart and I transfer them to essentially a gouge sheet that shows me where all those volatility bands are going to be. I can transfer that then to my intraday chart, and I also pay very close attention to these floor trader pivots. Floor trader pivots are inflections. They're just like fib zones. You know, some people say, well, you know, it's only going to inflect there. You know, you're not really predicting anything. And I would argue that if you're an intraday trader and if you're making your living trading securities, then really you're in the business of predicting intraday inflections. We don't really care where a stock is going to be 6 months from now or a year from now, or you know, if the coronavirus gets worse or if it gets better, or you know, whatever's happening. All we care about is this thing tradable today, and where do we think it's going to trade? So I always go through and evaluate what's happening in the pre-market. So obviously this was before the open today. I'm looking at this range right here, and I can see that I am trading inside the travel range of those prior session closing bars. I've got a very good probability that I'm going to get a long move into the open based on where I am in the range. I'm still in the upper part of the range from yesterday. And in fact, that's what happened. So when you look at these inflections in the pre-market, right, you want to bias it towards the closer you get to the open, the more important those bars are. And then once you see that price is moving within those volatility bands, With Apple in particular, what you want to get ready for is a reversal right off the opening bar. So there's going to be sort of a whiplash when the stock opens. Happens almost every day of the week, right? You can see that it happened here, and the stock bounces and gets up into the range, and we wind up having a nice move on the open here. Bounced right off the line that we thought it was going to bounce off of, that volatility band. Moves up when it gets to this band. We are at our first profit objective. When it starts to extend from this band to that second profit objective, we start trailing the stop up in behind here. And over the course of the day, we've got a bunch of different timing mechanisms that we use to either keep us in a trade or get us into the next trade. You can see here that I've got a fib study drawn, and that fib study is looking at the extension after that first bar of trading. We have a big move to the upside, trough to peak. The extension that is predicted by the fib study takes us up to roughly the R1 pivot. So we've got all that stuff in place from the night before. We knew exactly where R1 was. We knew exactly where the central pivot was. That's where we caught our bounce this morning. So now we're into the trade, and we see that we've got a fib expansion up at that overhead pivot line, and that we've got a good place to take a profit off the table there. Then when it comes back in again, it bounces off the high of that first bar of trading, which is the 100% expansion of that first range that we're looking at, right? So that's 100% of trough to peak on bar number one. Comes in, gives us a couple opportunities there for long entries on the bounce. And then you can see that over the course of the morning, just by isolating these ranges a little bit as they form, we've got really good predictive validity by doing our fib studies of where this stuff is about to go. That is the volatility-based trade that we're focused on most heavily right now. We love it. It's the thing that keeps us most active in the first hour trading pit every morning. If you join us in the first hour trading pit, you'll definitely be looking over our shoulder as we trade these live. It's not just us, it's about 40 people who have all been through the boot camp. So you can see sort of what other traders who we've worked with and we've trained are thinking about the markets. You get their opinions as well as mine. It's not just about what Julie and I are doing. There's a bunch of ways to peel the apple, so to speak. But what you really need to keep in mind is that a big chunk of this, once again, is about psychology. And when I say these are fast-paced trades, I mean they are really fast-paced trades. And what you see here on this graphic is they require counter-intuition. So a lot of times I tell people, the best thing to do when you have that gut feeling is the opposite, right? Whatever that gut feeling is telling you to do, just go do the other thing and you're going to wind up in better shape. That's because a lot of market stuff happens based on gut feelings. And you need to be able to anticipate the psychology of those other people who are trading based on what their guts tell them to do, so that you can go through and fade those moves the same way that a market maker does. They're going to sell into the panic buying, and they're going to buy the panic selling. And once you get a feel for how these volatility bands interact with price over the course of the morning, you'll see that that is also the thing that represents the best opportunity for you. So here's the slide. You can just look at the phone number there, and you can text if you'd like. Otherwise, I will send everybody an email that gives you the opportunity to access the site. What you need to do is just talk to Victor. Victor goes through and does a really good job of explaining to everyone how to use the website and how to navigate things and figure out what it is that we're talking about in the first hour trading pit. You don't want to be in there joining a conversation right in the middle, right? As we've said a bunch of times, you want to get in and know what's happening beforehand. So I've got Vic's phone number there. You can call him and he will walk you through it. And then also I've got this number here that you can text to. And if you send us a text, then what's going to happen is you're going to get an immediate access to tomorrow's first hour trading pit. So what you're going to do here is send a text to 310-299-9148. 310-299-9148, and you're just going to text the word room, ROOM. And what that's going to do is just give you an open house to what it is that we're doing and let you come in and sort of browse the goods for a few days. That other number there, 949-561-7066, That's Victor. He's a great resource. He can help you navigate the site and figure out exactly how to best use it during the open house that you'll have. You'll be happy for having talked to him because he's really very helpful, and people coming in from the outside and sort of kicking the tires on this thing always benefit from a conversation with Victor. So with that, I would like to open it up for questions. Go ahead and type your questions into the chat area, and we'll go through and answer these as best we can here. And if you have something that's more than we can do in the constraints of a chat, or if you're just not comfortable typing everything that's on your mind there, then you could just go ahead and let Victor know, and he will set it up so that I will have a phone call with you and we can talk through it. All right, so let's have the questions.